Hey everybody, it's that special time of the week. It's time for that TradeSmith video weekly newsletter. So let's get going here. Of course, the most important part of this video is the disclaimer. So you should be reading this, memorizing it. I would suggest composing music to sing along with it. That would be my suggestion. All right, look, breakout here. We had the little bit of a breakdown early in the week, but then broke to new all-time highs on the S&P 500. This is incredible type of action. Now, once again, this is not going to be an explosive bull market. Take a look just below that. Now, first of all, there's two lines there. So we have the chart, then we've got the purple predictor, and then we've got the green line down below. Now, the purple predictor is the on-balance volume, and it shows that the smart money is continuing to support the bull side of this market. But the green line shows that there's not a lot of momentum in this market. It shows that this is going to be a bull market that struggles. Now, that's okay with me because there's lots of sectors that are doing well. Of course, there's a lot of sectors that are not doing well. But as we can pick good stocks, we can make good money in a market like this. It's simply okay. We don't need to have the market in a bull market. We just don't really want it in a bear market. So look, gotta stay bullish here. Dow Jones, similar story, but not a new high. Also, look at the purple predictor is not supportive of those big cap stocks. The purple predictor is way weaker than the price action. And of course, the green line, the RSI, it's also much weaker. What does that tell us? Well, the Dow Jones is composed of big, boring old stocks. That's not where we want to be. The S&P is more of a mix of technology and boring stocks. It's more of a composite that really represents the whole market. So where's the action? The action's in the NASDAQ. Look at this thing. Look at this thing. That's where the action is. We don't want to be in big, boring stocks. We want to be in technology stocks. Now, for much of this year, as you know, I've been talking about consumer staples and utilities, and we did very, very well in those sectors. But those sectors are dead now. Now it's all about technology. Look at the purple predictor. Look how it exploded up 2 weeks ago. Exploded. And now it went from being below the chart to above the chart. Unfortunately, the green line did not make a new high, even though the price did. So look for a little bit of a setback this week in the market. Even though this is where the action is, it's still going to be weak action. Seasonality, or seasonality indicator, God, what can I say? Look, it's neutral because we're in a period when we're supposed to be neutral. And of course, the market has been neutral. Really, since the end of April, you can see we barely struggled higher, so nothing's really going on here. Now, I spent some time last week. I want to spend some more time here. What we want to do is we want to find out which price action is fitting what's going on. So let's take a look. There's the price action. We're making highs here. We're making highs here in the beginning of August. That means we got to get rid of the black line. The black line is not going to be the valid line to follow. Now, what are the lines that are making new highs in August are the top two lines. The purple line and the orange line, they're not making new highs. They are showing some strength, so we got to give a little bit of a possibility that they're the ones that are really counting. But the two that are showing the best analogy to what's going on are the top two lines, the green and the blue, because they're making new highs for the year. Now, what are those two lines? And this is all based on the presidential cycle. Well, the green line is that Hillary wins. That's what that top line is there. The incumbent party wins. And the incumbent party is, of course, Barack Obama, who's a Democrat. Now, the blue line is all presidential election years. So that's the line. It doesn't matter if Hillary or the Donald wins. That's what line we should see. So we should be seeing strong prices here. Then we should see a little bit of a choppy downward movement from September into early August and into October, and then a normal seasonal rally. Now, we may not even see that little bit of a dip. If it's pretty clear that Hillary's going to win, that would be the green line. Yield curve, this is one of the main reasons why the market is struggling, because the yield curve is coming down. Asset allocation shows that massive amounts of money are leaving the bond market and they're coming into the stock market. We're making higher highs and higher lows on this indicator, so that tells me still going to be the place to be is stocks. Bonds are going to be weak. We'll look at those in a minute. Our stock market risk indicator also not much of a bull market. And of course, you can see it's much lower than where it was early in the year, but still it is moving in the right direction, which is up. Global shares also starting to show some action. We're not making new highs, but at least they're challenging the old highs. Now, having said that, there's a couple of markets I want to be involved in. I think it's time to get into Australia. I predict that the Chinese market is going to be very, very strong. The economy is going to show signs of strength due to massive easing, monetary and fiscal easing. That'll boost the economy over the short run, which of course will boost the Australian economy and Australian shares. So maybe if we break the high that we made a week ago, that would be a great indication on getting into Australian shares. EWA is the ETF to use. Another one, Japan. We had the little bit of a sell-off when it was when the Bank of Japan did not ease as much as was expected. But I think that that's going to be pretty much over. And then what'll happen is look for Bank of Japan head Kuroda to try to surprise everybody and have a surprise easing. Keep an eye out here. This looks like another good market that we can get into, EWJ. Bonds, whoa, is that a complicated chart or what? So let's take a look at it. The first line I want you to look at is the purple line that's horizontal in the upper half. That is where the support and resistance is. It's old support, it's a big gap, it's old resistance, just that's the key line. That's the key line. If we break below that, I think we're going to head down to 131, 132. In the bonds, I'd want to be short bonds. You could short sell TLT. There's also short ETFs on bonds. That looks like a tremendous trade if we break the purple line. Now, I also have a red line on there. And so if you put the purple and the red line together, they form what's called a descending triangle. It shows that the bears are getting stronger. The bulls can't push the market up very much. The bulls are able to support and are able to show support and strength at 137, but they cannot. They're weakening all the time, which is shown by the downward slanting red line. So it's giving us an insight into the market. Now, and so that would be a descending triangle. Now, descending triangles are not usually topping patterns, so that would be a bit unusual. It does happen, though, so we have to keep an open mind. The green line is an uptrend line, and I don't really like trend lines because they're slanted. I don't like slanted patterns. I like nice horizontal patterns like that purple line. So that's a line that's made to be broken, and it's right there about that 137 level. Now, going back to the descending triangle, look at the purple line at the bottom showing declining volume. That's exactly what's supposed to happen in a descending triangle formation. So that lends credence that this is a valid formation which will be broken to the downside. If that happens, we should see the breakout on heavy volume. That would be our final confirmation. And the objective would be down below 132. Hey, that's a nice 5-point move. If you're a futures trader, that's $5,000. But even then, it's a nice move in TLT. So look to get short if we break that horizontal purple line. Bond key factors, 2 now, I'm counting as saying higher interest rates and 1 down. So this is supporting our technical picture of the descending triangle. So look for higher interest rates on the bond sector. Here's the dollar, and I think the dollar is becoming more and more important. We were in a nice bull move. Then we saw the Japanese surprise everybody by not easing as much. But now the bull market looks like it's back in force. We got a little bit shaky there. Overall, this is a sluggish bull market, very choppy, and I think it's going to continue to remain that way. I want to generally be on the bull side, but the reality is I don't really want to trade the dollar because it's so sloppy. I like easy markets to trade. All right, now, if the dollar is strong, then that means that gold should be weak. Now, look it up here. We didn't make a new high. that could be a failure top, because if we're in a bull market, we're supposed to make a higher high. We didn't, and then the market cracked down on Friday, and a break of the uptrend line would be a preliminary signal of a top. A break of 1310, that level would be, to me, would be the end of this bull market in gold. Also notice that we're starting to see that the down movements are being validated by the volume down at the bottom. So I've been bullish for quite some time on gold, but this is not looking good. So I want to kind of pull in my horns here a little bit. However, these indicators, look at them. I counted them all as bullish for gold. But look at the top indicator, which is the euro. It started to turn down. And look at the bottom one, that's the yen. It started to turn down. So I may be late. In other words, they may have already turned to bearish. So I don't know. They're green, but they probably should be somewhere between green and red, whatever color that is. All right, oil. Just looks bearish. We got a little bit of a rebound here last week. Based on this trend line, maybe we'll get up to 43, something like that, and then we should expect the bear market to continue. There's nothing on this chart. There's nothing in the fundamentals that suggests that this market could go back into the bull market. All right, everybody, all you freebies, you really ought to subscribe. It's really the coolest thing. All the cool kids subscribe, and you know you want to be one of the cool kids. Now, I also want to tell everybody that we've got one of our great stock success schools coming up. It is the Premier Stock Trading Education. That website up at the top has got a super cheap price. It's coming up in just a week, so there's not a lot of time to get involved in it, but I thought I'd let you know. And I'm going to teach the techniques I use to manage the #1 mutual fund in the United States. Yes, that's right. I manage the #1 mutual fund in the United States according to Morningstar. Now, there's 30,000 mutual funds in America. There's only 13,000 stocks, but I was able to whump everybody's butt. All right, it's a live seminar. You're going to really enjoy it. Check out that website up at the top. It's only a week left, but we'll be doing it again. All right, freebies. Love having you here. Would love to see you at the Stock Success School. Would love to have you subscribe. But hey, it's cool. And by the way, our podcast, which you might be seeing it on here, 5-star rating, unbelievable, great reviews. I want to thank you all for giving me those great reviews. That's fantastic. All right, fully paid up members, hang on in just a second and we'll get into all the specific recommendations.